Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Hi, I'm your host, Erin Allen with BMO ETFs. Welcome to today's session, where we're going to be covering the 5 most common pitfalls of investing and how you can avoid making some of these mistakes in your investment journey. So you've probably heard of some of them, maybe you haven't heard of others, but when markets are volatile like they are today, I think it's really important that we recognize the potential of these hazards and recognize them, how they can affect you meeting your goals, and it can go a long way in helping you reach those goals. So just as a reminder, today we're not providing you any advice or investment recommendations. Today's episode is about providing education around investing for investors who are looking to take charge of their own portfolios. And with me today is Jonathan Chevreau, and John is the Chief Financial Officer of the Financial Independence Hub. He's also author of the financial novel Findependence Day and editor for moneysense.ca. So you can check out his website at findependence.com. And I would also like to welcome back McKenzie Box, who hasn't been on the show for a while because she's been on mat leave, but McKenzie is the Vice President of Product and Strategy at BMO ETFs. So it's great to have you back, and thank you both for joining me today. Before we get started, I just want to give a quick reminder to check out our YouTube channel, ETF Market Insights, where you can watch any episodes that you may have missed. Remember to hit subscribe as well, that way that you get notified every Friday when we post a new episode. All right, so for our 1-minute update today, I thought this chart was really powerful because it shows that there's really always a reason not to invest, and it goes all the way back to the 50s. And there's always some sort of economic uncertainty, political instability, or another wild card that the markets are throwing at us and keeping us on our toes, and it's keeping people out of the markets. But what I hope today's presentation will show you is that when you take steps to avoid some of these investing pitfalls, you can really have confidence that you're going to be on the right track to realizing your financial goals, whatever those may be, even when the markets seem a little bit unwelcoming as they do this year. So John, thank you so much for joining us. As I mentioned, you've developed the Financial Independence Hub, which is findependence.com. And it's really just a North American site dedicated to all things related to financial independence, personal finance, stock markets, real estate. I can't think of a better person to have on today to walk us through some of these more common investing pitfalls. So can you walk us through number 5 here, which is investing based on emotion?
Sure, Erin. Just want to clarify, the site is findependencehub.com, and my title, I fool people all the time. The CFO is Chief Findependence Officer. So
very good.
That's just my little marketing thing. Anyway, going to the pitfall number 5, investing based on emotion. So unfortunately, we all know investors are all too human when it comes to money and emotions, and particularly in times like this. Nobody likes to lose money. In fact, we feel twice as bad as losses as we do about gains. Now, if you ever watch Mad Money's Jim Cramer on CNBC, every time there's a downturn, he says, "Nobody ever made a dime," panicking. And as you can see, panic is one of the stages about midway through this chart, which we'll go through. So, I mean, arguably one reason for using an experienced financial advisor is to help manage emotions and stress during the bear markets like the one we seem to be in 2022. Like, we're all geniuses in a bull market, don't need any help, but in a bear market, not so much. Personally, I'm more or less a do-it-yourself investor, though I do have an advisor sort of on an hourly basis. And I think if you have the temperament and the experience, you can probably get by with as you mentioned earlier, the asset allocation ETFs with low cost, and you buy and sell them on any discount brokerage, including BMO and all your competitors. So in theory, just one asset allocation ETF like VBAL Vanguard, XBAL iShares, or BMO's own ZBAL, they're all theoretically the same. About 60% stocks, 40% bonds, spread around the whole globe, which is basically the classic mix, the asset mix of a pension fund historically. The reason 2022 has been so stressful is that normally these balance funds, as you know, if the stocks do go down, the 40% in bonds go up. And so you have this nice balance. What's been so stressful in 2022, I speak personally, and probably we all do here, is that both sides are going down. The stocks are going down and the bonds are going down because interest rates are going up. So little wonder that's stressful. People feel like, well, where can I hide? Short of cash up till now, really paid zero. And of course, right now, all the central banks from Canada to the States and everywhere else have been raising interest rates in a desperate effort to get inflation down. And that's just adding to these bond market losses. So, I mean, you probably go through the asset classes, but certainly a 10% loss for 2022 on a balanced portfolio is not fun. And then you add to all this, Russia and the invasion of Ukraine, the threats to American democracy, with the Republicans and all their shenanigans. And then every time you walk into a grocery store, you see the rising cost of living and the price of everything going up. You add all that, and then you look at your portfolio, and you seem to be losing money at sometimes 1% a day. Quite stressful. Little wonder some people think that they should move to cash. And in fact, some newsletters I've been getting, the more bearish ones, I get a lot of them, are saying, hiding cash, 85% in cash is one of them. I mean, I don't advocate that, but that's what people are thinking. But of course, and I'm sure we'll go through this, we all know the market timing is next to impossible. And personally, I believe in strategic asset allocation, which is essentially what these balanced ETFs do. And that really means not making wholesale changes in asset classes just because of negative headlines. So our best example of this was COVID in March 2020. People who panicked and sold right when the market tanked. I think it was the fastest bear market in history. It was over in like 6 weeks. So if you triggered your losses, and who would have thought to come right back in time for that one? So that was a good example of maybe nobody can really successfully and consistently time the markets.
It's very hard to do, right? Studies have shown that it's next to impossible. So yeah, not ignoring emotion. We're not suggesting you should ignore emotion. Definitely, listen to it, but don't make rash decisions in your investment portfolio based on it, right? Like a lot of it depends on your investment time horizon and that type of thing. And all of that needs to be sort of taken into consideration as well. So all of these things telling everyone to go to cash, it does make me wonder, if you do have a long-term time horizon, it might not be the best thing for your wallet, right?
No, I don't advocate that, but can we go back on that slide one to where we were? Is this a one-way?
No.
That one. So clearly, I think we're in euphoria. Was late 2021, and then early in 2022, earlier this year, I guess, we've gone quickly through anxiety and maybe denial right now. Wednesday was a pretty good day because the market went back up on the Bank of England thing. But as we tape on Thursday, markets were down again. So I think we're back to somewhere between fear and panic. Like some of the advisors are suggesting we're quite close to capitulation. Who knows? It's certainly probably the better time to buy than to sell. But again, if you have 5 years out, I think you have to just stay with the course. So if you can go to the next slide, that was the one on the fear and greed. Yeah, where are we now on that? I mean, maybe other people haven't. I'd say we're in somewhere between fear and neutral. I don't think it's extreme. Does anybody else think we're extreme right now?
This is the CNN's take on it. So they're always a little bit more fear mongering, but this is taken earlier this week, and they say we're in the extreme fear mode right now.
Yeah, I guess it depends on your asset allocation, your age, and how well you prepared your portfolio in advance. What's the next one? Next slide. We got one more on this thing. Oh yes.
Yeah, you touched on this already.
Yeah, it's good that I had the number right. Yeah, gains are about or actually losses are twice as impactful as gains. So you can make if you make $1,000 on a stock on the upside, you're going to be just as upset by another stock that goes down only $500.
Yeah, that fear of loss is twice that of the desired feeling that we get when we get our gains, right? So definitely remembering to put those into perspective is important when making any decisions.
It's the problem of being an investor, being human.
Yep, we can't shut it off, right?
Well,
Let's go to the next pitfall, Johns, which is investing too conservatively. Can you walk us through why this is one of the biggest risks for long-term investors?
yeah, I guess let's start with the term long term and then short term. So long term to me is 5 years and out. And as people say, you shouldn't invest much, if anything, in stocks if your short term goals are below 5 years, i.e., if you're saving for college or to try to get a down payment on a home, you probably shouldn't take any risks. But most, I think, pretty much the financial industry and probably most of the clients that BMO serves are people who eventually want to retire or semi-retire. So you're saying that's 15, 25 years out. So given that perspective, you should really think of buying opportunity when the markets are down. That's the best time to buy. It's the old thing of best time to buy sardines is when they're on sale, or shoes, or anything else. Um, and I think we'll go through the asset classes and their returns, but clearly most people would agree that stocks are the best single asset class to generate returns in the long run. Again, defining it as long term, 5 years or more. Now, just when we were looking at that chart about the emotions, and when we were late 2021 even, and everybody was looking at their all-time high portfolios, that was still the era of Tina. There was no alternative to stocks. If you remember, at the time, you were lucky to get, well, you basically got zero in a bank account. And even if you had a GIC, a guaranteed investment certificate, or a money market fund, you'd be lucky to get 1%. So in that environment, stocks made sense, taking risks and making, at least you'd get what, 4% on a good quality dividend paying stock. But that nowadays, in the last 6 months in 2022, all of a sudden things have changed. The banks are, I mean, for the longest time, it was very hard to be a fixed income investor or semi-retiree trying to live on, for example, GICs, as I said, that paid nothing. But now, in the fight to raise interest rates to combat inflation, all of a sudden, GICs are paying pretty decently. I mean, I'm in semi-retirement, so I don't advocate anybody being all in cash or any one asset class, but the portion of my fixed income portfolio that's in GICs, I'm quite happy to reinvest. What was paying 1.5%, right now you probably get 4.5 or even 5% on a 4 or 5 year GIC. Now you'd be the first to say, yeah, John, but inflation is 8%, so you have a real positive return of -3% in that scenario. So that you still need to think of the long run and a certain amount of stock and equity allocation. But again, I would never counsel being 100% in just stocks, just bonds, or anything.
Yeah.
I've written in Money Sense about Ray Dalio's all-weather portfolio. Two of the major asset classes are stocks and bonds, which are covered by the asset allocation ETFs we mentioned. But he also includes, and these are particularly significant in an inflationary environment, he includes commodities, gold and precious metals, inflation-linked bonds, which are real return bonds in Canada, TIPS, Treasury inflation protected securities in the United States. And there's funds and ETFs that do that, including from BMO. So in summary, I think you can talk about, you can still have those asset allocation ETFs, maybe 70% of a portfolio if you're a DIY investor, but the other 30 or 20% can be in a mix of commodity ETFs. Commodities have done very well, right? Under inflation in 2022. Same with, well, gold hasn't done very well either. And for that matter, Bitcoin, supposedly a inflation hedge, has done terribly, down 50%. REITs and real estate ETFs, for example. And I think BMO has probably ETFs for all of these, including one I own, which is the BMO Infrastructure ETF, which I think we ran on the Findependence Hub last month sometime.
Yeah, I think like when it comes to newer investors, or when we look at investment products, we often look at the risk level, low risk versus high risk, and we think, oh, well, I don't really want a lot of volatility in my portfolio. You know, maybe I'm a low risk investor, but I think it is important, right, to be looking at what are the market conditions and what are your actual goals here financially, because we can't just take a low risk investment and expect to necessarily hit those goals depending on what they are, right? And you touched on inflation here already, but it's definitely a major concern today that we have to be careful about, and these are a little bit out of date, but yeah, it probably looks a little bit more stark if we were to run these today, right? With inflation, like how do we keep up
Well,
with that in a conservative portfolio?
right now, yeah, you'd probably be seeing that 1-year GIC paying 4%, Canadian inflation 8%, 5-year GIC 5%, Canadian bonds probably negative 5%, maybe even 8. Canadian balance might be down 8, 10%, and Canadian equities, you tell me, probably a bit negative as well. So yeah, we need to update that slide for sure, but it still gets the point is in the long run, and relatively speaking, this is what you're going to expect. I don't see international equities or U.S. equities there. Interesting right now, the U.S. and under all these circumstances, the U.S. dollar, there's been a flight to quality, safety, and the U.S. dollar is rising way up, which means for Canadians, it's probably a better time to take profits in U.S. stocks and put them in the Canadian dollar. Uh, Conversely, probably a little more expensive for us with our Canadian dollars to buy U.S. stocks, even if they're at these bargain levels. But I think long run, this chart really does show if you want to beat inflation, that's the whole point is the Canadian inflation there 1.59 and the equities and balanced probably 2 or 3 times better. And in the long run, I think this is the sort of thing we would expect. So
You have to take on a bit more of that equity risk. Great. Well,
yeah,
thanks for those insights, John. Now, McKenzie, I want to turn to you. It's great to have you on. Can you walk us through this third pitfall of investing? So underestimating the power of compounding. What do we mean by this? Why is it so important?
Sure. Thanks, Erin, and thanks for having me back. So compound is one of the simplest ways investors can grow their wealth. And by not doing so, they actually miss out on opportunities to earn more. So compounding is really investing earnings or income back into your initial investment, which means you can earn income on top of income, and it allows you to generate additional earnings over time. And one way you can do this is through continuous savings plans, or even if you think of DRIPs, which all of our BMO ETFs have, by reinvesting that income back into your initial investment, you can gain more over time. So it's just theory, like a little bit adds up over time, and by continually doing this on an annually or monthly basis, whatever it may be, you can just reach your goals that much faster. And so the example here on the slide tells you it's just a basic for math purposes, $100 over 20 years, $100 a month over 20 years with a 6% compound rate of return, you would end up with over 46K. So just by adding a little bit each month, whether it be through savings plans or DRIPs or whatever it may be, you can really achieve your goals a lot faster.
Yeah, sort of that multiplier effect, right? And it just increases over the longer term. So start early, because that compounding effect will do more for your portfolio over time, for sure. Thank you. All right, so the next pitfall, sticking with you, McKenzie, can you explain why not staying invested is such a risk?
Sure. I think this is probably one of the biggest mistakes, and I think even John alluded to this, is that investors are inundated with all these daily head noise about markets. In many cases, it's short-term noise, sometimes a little bit longer, but in some cases, like he said, it's a 6-week period and then markets rebound. You know, equity markets are volatile. You'll see day-to-day fluctuations, which can cause investors to react and potentially miss out on market opportunities. And I find, you know, we read these headlines and you look online and everything you see is, you know, interest rates, inflation going up, and I think everyone kind of gets spooked and they make the mistake of selling at the bottom, but not capturing the upside return of that market. So like John had said, that 6-week period, if you had sold at the bottom, you missed that full rebound during COVID. So, you know, I think It's more about time in the market instead of timing the market, and having that long-term time horizon so you can achieve your goal.
Love it. Love that quote. That's a quotable quote. Time in the market, not timing the market.
Can't say it's mine.
All right, thank you. And then for the last pitfall here, John, I'll turn it back to you. Putting all your eggs in one basket. Now, of course, the basket doesn't have to be one stock, could be one sector, one region, one geography, but talk us through this one, please.
Yeah, well, this is classic of diversification, and there are people who think that they believe you can concentrate investments in one big single egg, and the idea is if you plan to watch that basket religiously, like 24 hours a day, but who wants to do that? Typically, I think that risk only arises when you have a single stock, usually an employer stock, and the classic would be the example of Enron, where people had all their wealth and their stock plans and their version of their RSP in Enron stock, and then when Enron went south, so did all their financial capital. It should be the opposite. If you're employed by any one company, you want to invest in everything but that employer, I would say. So as I mentioned about the all-weather portfolio, you could view just a single. If you think of one of those eggs not as a stock, but as equities, as you said, and another one bonds, represented by broadly diversified equity ETFs and or broadly diversified bond, or a big giant egg, again, the asset allocation ETFs that we talked about. But that's very diverse. It's not really one big giant egg. It's actually all the world, all market caps, pretty much all sectors, and those two dominant asset classes. But again, if you want, even then, you could go to maybe have three smaller eggs, 10% eggs perhaps, as I mentioned in the all-weather portfolio, where you would have commodity ETFs, precious gold metals, real return bonds or inflation indexed ETFs, and commodities. And I think at that point, that's about as diversified as you can be, and not forgetting that the cash can be yet another one of these asset classes. You can invest. You can also invest, of course, according to currency, keeping in mind the old maximum that Canada only represents 3 or 4% of the global stock market. You could argue that U.S. is closer to 40 or 50%. So this particular asset class here, I've written about this in the past, was in the Post and in Money Sense. I think they're very instructive, these charts. Here you can see, well, again, I just mentioned U.S. equities, and you can see U.S. stocks were the top asset class in 6 of the last, 8 or 9 years. And then you look at the bottom, cash is the worst asset class in 1, 2, 3, 4, 5, half the time. And then things you'd expect to be volatile, sometimes up, sometimes down. The dark blue of emerging markets, top of the charts in 2 or 3 years, bottom of the charts in the other 2. And then what you'd expect, exactly what you'd expect, balanced portfolios and bond funds sort of in between. So most people, and in fact, again, the asset allocation ETFs would probably provide all of this automatically. So you don't really need to worry about incurring tax consequences and trading costs by trying to switch between all these classes. Because the only thing we know for sure, as this demonstrates, is you can't predict what's going to be the leading class next year and what's going to be the losing asset class next year.
Mm-hmm. Unlike sports betting, where you have to put all your money in one team, with investing, you can bet across teams, across asset classes and geographies, and have a more diversified, lower volatility outcome. And that's a great segue, John. And I know you've been talking a lot about our asset allocation ETFs, but McKenzie, walk us through an overview of our offering and how these can be great tools to help avoid some of these mistakes.
Sure. And John, thanks for the good segue into these asset allocation ETFs here. So they're a great all-in-one solution that provides instant diversification. And I think it's a great solution set to really combat those common pitfalls we see of investing. They're professionally managed, automatic rebalancing, which helps keep you on track to your kind of risk return objective or your time horizon, whatever it may be. They're low cost and extremely liquid. So it takes kind of all that emotion You know, whether you're influenced by short-term noise, if it's, you know, if you want to compound, whatever the case may be, it kind of takes all those things and it's an easy all-in-one solution that allows you to get great diversification, and it's professionally managed one-ticket solution. So at BMO, we have 6 asset allocation ETFs. So depending where you want to position your portfolio, all of them are 20 basis points MER. So if you want an all equity ETF, a little bit more growth focused, balanced, conservative, or more income focused, and we even have an ESG focused asset allocation ETF. So a full suite of solutions to help you reach your goal, and depending on where you want to allocate your money in your portfolio, whether it being kind of more of a core position or you want it to be more of a satellite position to a complement of some of your existing portfolios. We have a wide breadth of different solutions that can work for your portfolios.
Yeah, I'm so glad this innovation came out. I think it's just a great tool for investors, and I think we will probably be coming out with more of them as we go forward too. All right, so that wraps up our discussion around the 5 pitfalls of investing. Before we close out, I want to turn to a couple of the audience questions that came in this week. So McKenzie, I'll ask for your thoughts on this. What are your cash alternative solutions that are good for shorter term as I wait for new opportunities?
Sure, and I think like both you and John had mentioned earlier, we're seeing a lot of cash or cash-like instruments that are gaining popularity within headlines. You know, as we see markets, they're anticipated to be more volatile. Central banks are expected to continue to raise rates to combat inflation for as long as they need to. Hopefully not too long. But given that, I think BMO, we have a money market fund, which is a great alternative, as well as our ZST, which offers investors attractive yields, protection against rising rates, and intraday liquidity. And they also have no lockup period, so it's not where you're set for a 1 year, 5 year period of time. It can kind of move with the market, which is very attractive for investors, especially in this environment.
Great. Okay, so ZMMK is the money market and ZST is the ultra short-term bond. Okay, let's look at the next one. I've been hearing about tax loss selling. When should I do that?
Well, given markets in the current state, I think there's no time like the present.
It's a great year for tax loss selling.
Given the year that we've had, I think it's a really good opportunity. So tax loss selling or tax loss harvesting is really disposing of securities with capital losses, so investors can offset their taxes for securities that were sold at a capital gain. So there are a few requirements with it. You can't repurchase the security for 30 days. You can't go into the exact same product if it's an index-linked product. You can't buy something that follows that exact same index. So there are some tips and tricks around it, but we have a great desk that helps alongside that. We've done this in the past with many clients, and I think it's something that really can help you going into tax season.
I might add, obviously you should do this in what's the tax year 2022, so before December 31st, but you usually need 3 or 4 days for the trades to clear. So yep. I would think in my mind, like, don't wait till after Christmas.
Yes.
Yeah, there's always a date, and I think I don't have it off the top of my head, but I think you have to be careful of all those holidays in there, right? And you need about 3 days for that trade to settle within 2022 for it to count. So yes, definitely good point to raise, to be careful about those dates. Get it done early. Okay, well, thank you guys. That caps off another great week of ETF Market Insights. Thanks to everyone who tuned in, and thank you to John and McKenzie for your great insights around the 5 pitfalls of investing. Next Friday, we will be off for Thanksgiving, filling our stomachs with turkey. We're returning on October the 14th, where we're going to cover currency. So currency risk, how to hedge it in your portfolios, and how ETFs can be a great tool to help you manage this. So I'll be joined by Omanand, who is a member of our portfolio manager team at BMO ETFs, and we will also have Investor Line on, who will be walking us through their latest offers. So I hope you'll join us then. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.